an important market voice. Anup Maheshwari, Head Equities and Corporate Strategy at DSP BlackRock, joins us right now on the show. Anup, really good having you. Thanks for joining in. You know, the comments from a few industry bigwigs the last couple of days probably lead one to believe that the budget will have to dish out something which makes corporate India to believe that it could be a budget for Achhe Din. What's your sense on the leeway that the FM has and the possibilities of it being a good budget for the markets?
Yeah, so Niraj, you know, this is very typical ahead of every budget, and this one in particular, that expectations are set really high on that one particular day. You know, frankly, we still believe very strongly that this is just a process by the government, so one day can't really come up with everything that the market's looking for. But the fact remains that the onus is on the government in this particular case to get you know, the economy back into a little bit of growth mode through investments, because that's clearly the only engine that can get it back while the others are still slowing down. And therefore, there is a lot of focus on how the government plans to spend money. They have leeway thanks to you know, oil prices coming down, subsidies generally going lower. So there is leeway for the government to definitely step up capital expenditure, and given what they've said so far, there is a lot of optimism that it will be done sensibly, and that really, I think, will be one of the key focus areas for the budget itself. But you know, we still think it's a process. You know, it's very difficult to encapsulate everything in a 1 hour or 2 hour speech and the details of the budget thereafter. I think you know, right through the next couple of months, that will be the area that will be focused on in terms of the level of expenditure that the government is going to make and how quickly it will start, so that we start seeing the effects flow through into the economy over the next 1 year or so.
So, Anup, what is the sense? Could budget this time around turn out to be a market-moving effect, or do you think, like many previous budgets, it's not going to be much of a game changer and would be rather a non-event?
Well, Ayesha, you know, markets being markets will respond very aggressively to whatever is any information thrown at it. So I'm sure there will be a fair amount of volatility around this budget as well. It's just that, you know, when expectations are set really high, invariably it's a little difficult to match it. In any which case, we do have a situation at the moment where valuations for the market, you know, don't look all that cheap anymore, so that easy gain of valuation upside is now fairly limited. It's more driven incrementally by earnings growth that needs to come back. That is taking its time. So to that extent, you know, if there's too much of a move around the budget, you know, it will probably lead to some disappointment thereafter. But as I said, that's just a day. It really doesn't matter in the broader scheme of things. What's really important is the trend that the government outlines for the economy over the next 12 months, how they're looking to spend their money. And I think that will eventually drive earnings and the market going forward. So on the day, you know, people will react the way they want to, but I think we have to really look beyond that.
Since you did talk about earnings, Anup, you know, that's the glaring loophole right now, that earnings have been so disappointing, but the market seems to be completely running ahead of the expectations. Now, I know that market is working on earnings assumptions 2 years from now, but do you think in the next year there would come a point when perhaps markets would want to meet reality and come off and match up to where earnings are currently?
Yeah, it's a very interesting question and something we keep wondering all the time. But you know, we have seen that while corporates are obviously communicating, and we've seen the results haven't been great, and even now the environment seems to be only, you know, it's not something that the corporates expressing much optimism on in terms of the uptick. But the fact is, you know, most people don't really realize exactly when things have bottomed out. Just like you don't really realize at the peak of a market that 6 months later your earnings might slow down, you're not exactly clear when your earnings will start picking up in the reverse cycle as well. What we're just saying is, after 7 years of 8% earnings growth, which is really suboptimal from our long-term historical standards, the probability with every passing year of getting back to a 15 to 20% earnings growth keeps rising. And I think this market's looking to anticipate that, and in a way it's also indicating that there is a turn coming at some stage. So, but you're right a bit in terms of just the timing of all this, in terms of how much of it gets priced up front, how much do global factors impact, etc., without actual numbers being visible on the ground. And more than that, I think it's more the mix of the market that one has to be a little careful of, which is you have one part of the market that is extremely expensive, almost becoming bubble-like in terms of valuation. And then you have a lot of value names also in the market which are waiting for an earnings turn. So it's a very split market in that sense, and I think the market itself still presents a lot of opportunities. But at an index level, I think it will end up being more in line with the eventual earnings growth that we'll come across.
Okay, by the way, there is a smart move that's happening in Dredging Corp today, 12.5% up, and it's just moved up, I think, in the last few minutes of trade, because it was up barely 3 or 4% a few minutes back, and then there has been a sharp uptick that's come into a Dredging Corporation in today's session. But Anup, I'll come to the index heavyweights or the index components in a bit. What about that end of the market, which is probably showing a promise that's hard to ignore, but there are no earnings? I'm referring to railways, I'm referring to defense, and almost everybody says that earnings for these companies will probably come in 2 years, 3 years down the line, because these are long gestation projects. But it's a promise that you can't really ignore, because the government is talking about it very, very actively. What do you do here?
Well, in some of the thematics and areas like this, finally the reality is from cash flow. I mean, there's no doubt. It's even, we're seeing the same thing in the internet space, for instance, where you get very high valuations on the theme. And you can keep running those for a while, and it can be a fairly long while, but you finally do need profits to come through. And defense obviously will scale up. The whole rules of the game are changing, and there's a lot of focus on indigenization now. So it will present very big opportunity, which this market will discount a good amount of it up front. So there is some justification for some of the moves that we've seen. But you will keep going through these periods of mismatch between stock prices and actual earnings on the ground, and some corrections on account of that. But I guess over time, as long as the business eventually comes through over the next 3 or 5 years, there will be an economics link to it that we'll see, and that will probably justify to some extent the rise in the market cap that we've seen in some companies in this sector.
But you would be optimistic on these plays? My simple question is just that, as a fund manager, do you allocate capital out here because the earnings are only going to come in a couple of years down the line, but the promise is there? What do you do?
Yeah, so what you do in your portfolio is there are a few names that you do have. Unfortunately, they may not be very large, so it's not like a very meaningful component of your portfolio, just given the size of the space currently and the investable options available. But yes, in certain funds you do identify some names and just stay with the base position, so that over time, as these ideas scale up, you're participating along the way.
Do you fear, Anup, that perhaps not just defense, but a lot of these pockets are beginning to get somewhat of a crowded trade? And why I say that is because, purely because there's a long gestation period from what comes on paper to, what or rather when it translates into earnings. Are there any sectors which are somewhere getting a little overheated or overcrowded, or not quite?
Yeah, so there are a lot of stocks that you could argue are trading currently at valuations that are far from reasonable, and it's almost becoming like growth at ridiculous price now. But if you just cut the market into two zones, so what we've had is large cap and small cap. So there's been a bit of obviously a dispersion there in terms of performance. So that's one spectrum of gap or variation in performance, and then the other spectrum is high ROE with base earnings growth versus low ROE companies. And we've seen the high ROE companies do exceptionally well, outperforming the low ROE companies by a margin of 2 times almost. So, but you're paying a very high price for those high ROEs as well. And in some cases, you haven't even seen good enough earnings growth, but these companies have continued to re-rate very dramatically. So there is a bit of, there is a reasonable overvaluation to that extent in one part of the market, and that's where all the momentum is at the moment. So it can stretch, as we've seen before in previous cycles during the tech boom as well. So these things are very difficult to rationalize for a certain period of time, but it's just the money flow and the stretch of the momentum that carries them forward. But this is a period where we have to look back at our portfolios and make sure that we have a balance and we're not too skewed towards just one category of stocks that's performing very strongly, irrespective of valuations.
So last month, Anup, I recall reading one of your interviews, and you said that you are overweight banks. With the kind of disastrous earnings that we've seen from some of the PSUs and some of the private sector boys as well, have you changed that view?
No, not really. The private sector banks have done reasonably okay. I mean, we haven't seen too much of an issue with the results coming from the private sector banks, and they've continued to perform quite well. And I'd put them into the category of decent ROE spectrum that is continuing to perform quite well. The public sector banks obviously have had a very bad sort of result season, and very unexpected in some ways, because most people were expecting the non-performing loan scenario to start actually peaking and coming off. But we've seen an extension of that cycle, so that challenge for them does continue. To some extent, therefore, public sector banks have been a bit of a challenge. But you've got to sort of take a more medium to long-term view on these things and maintain your balance. So our balance is still anyway tilted in favor of private sector banks. But while it's not a bad idea to buy companies when results are coming hopefully close to their all-time worst levels. For let's say the next 3-year cycle that comes through.
Would that argument hold out capital goods stroke infra space as well? Because I hear murmurings from corporate India about signs of this happening.
Yeah, so again, even in capital goods, we've had a lot of divergence. Some expensive names have become more expensive, and some cheap names have remained very cheap. Also, capital goods, it's a fairly wide area, frankly, for spectrum for investing. But our sense is it will still be a late beneficiary, because we first have to see the government step up the whole investment cycle, and then, a few years down the road, the private sector will step in. So I guess the progression of earnings for them will probably still take some time, and therefore, your degree of patience and exposure in your fund has to be modulated accordingly.
Okay, so before we thank you, Anup, you've given us the broad theme for the markets. What's your top overweight and underweight right now? I believe banks are one of your top overweights. Is there something else which is even topping banks as your overweight position? And are you underweight something right now?
Sure. So private sector banks, we're still overweight, as well as consumer discretionary. So those are the two areas that are probably on the higher end of our overweight positions. And on the underweight side, we're underweight telecom at the moment. We're underweight some of the utilities, but they're very small components of the index in any case. So these are not severe underweights, but that's probably the area. And consumer staples, of course, that's another big underweight in our portfolios.
% earnings growth for FY16 still seems to be a distinct possibility, Anup.
Yeah, I mean, our sense, we're still going with the belief that FY16 and 17 will see in the region of 17 to 18% compounded earnings growth. Yeah, I mean, I think we'll work with that hypothesis in terms of our view on the market as well for now. Because as I said, after a 7-year cycle of suboptimal earnings, it's a matter of time before we start getting that earnings come back. So we're very confident of the fact that the next 2 or 3 year cycle should definitely see higher earnings growth than what we've seen historically.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.